How does a Donald Trump win affect my finances? This is the question I think a lot of people are asking themselves the last couple of weeks since the election. And I just wanted to come on today and talk about three broad ways that the Trump and Republican win, across the board, likely affects your finances going forward. Now, you'll probably get a little bit sick of me saying this, but I don't have a crystal ball. These are not predictions. These are just assessments and observations of policies that might be coming down the hatch and how to think about them and what to look out for as things evolve over the next, year, 2 years, 3 years, 4 years. So I think three broad ways that we can think about this are: 1, financial markets and investments; 2, interest rates, right, which are kind of a subcomponent of the first broader category, but they are very important. So I think they warrant their own discussion. And number 3, taxes. So these are kind of three areas that I see being drastically affected by a Trump and Republican win. And I just want to go through kind of things to think about in each of these. So let's talk about number 1, financial markets and investments. So for most people, this is going to be their real estate holdings, their Roth IRAs, their TSPs, their 401ks, their brokerage accounts, whatever investments they might have. So we did see a nice bump after the election. Things have settled down since, but we certainly did see a great return like the day or two after. Was partly because of potentially pro-business policies, also partly because of just the certainty that we had with that election being such a landslide and not having some sort of contested, drawn-out saga, kind of like we did back in 2020. I think the consensus in financial markets is that a Republican majority will have generally more pro-business policies, right? Cutting the corporate tax rate, deregulating a lot of the laws and regulations to make businesses able to find ways to make more money and be more profitable. Also, I think the consensus among economists is that the proposed potential tariffs that may come in a Trump presidency will likely have inflationary effects in the US and across the globe. So what does inflation typically mean? Let's think about the US stock market, for example. If the S&P 500 over the last 100 years or so has returned about 10% before inflation. Inflation has been about 3% over that time period. So the real return of that S&P 500 has been about 7%. So if tariffs do in fact cause inflation like many economists predict, what does that mean? Well, if inflation is, let's just say double, let's say it's 6%, just for argument's sake, and markets do their thing like they have over many years, maybe that return would be something like 13 instead of 10%, right? So to me, what does this mean? This means you need to invest, just as always, right? That's the lesson. That's the takeaway here. We don't really know what's going to happen next year or the next 4 years, but if there are inflationary trends and companies become more profitable and are making more money, and there's inflation all over the world, we definitely want to take part in those market upswings and have our money in the stock market. We certainly don't want to have it sitting in a bank account. So that's kind of the big lesson there. Another thing from markets, I would say, is like international markets, going to be really interesting. They've underperformed the S&P 500 by a pretty decent amount over the last 10 years, so 10 to 15 years. So many people ignore them. I think they're going to be further ignored during such a pro-business, pro-US regime. I think many international companies and many international countries are kind of scrambling right now to figure out how are we going to do business with the US. I think the prognosis for a lot of these companies in the short term is difficult potentially. And you're going to see a lot of, commentary talking heads on the TV talking about how the US is the only place to invest and this and that. To me, that just means it's going to be an even greater buying opportunity in international and emerging markets. I can tell you, me personally, this doesn't mean I'm tilting my portfolios more towards the US and more towards international. We're just going to maintain that same mix that we've been investing in. So if US outperforms international, we're just going to be naturally buying more international. Again, there's nothing fundamentally changing here over the next 40 years. This is a short-term volatility in US and international markets with the politics that are going on. So me personally, as an advisor and investor, I'm just going to stick to my guns, stick to my plans, what I know about markets, and not get, too overly emotional about being pro-US or pro-international. We're just going to stick to that, maintain that discipline of that diversified portfolio where we're naturally buying stocks. When they're lower, we're buying more of them. When they're higher, we're buying less of them. On to number 2 now, interest rates. So the consensus, again, lots of inflationary policies potentially coming down the hatch with tax cuts, right? More profits, companies do better, as well as tariffs on goods from overseas. So those two things are very inflationary. So the consensus is, higher interest rates for longer, kind of that higher for longer mantra we've been hearing from the Fed. This affects obviously interest on savings, mortgage rates, right? Bond yields. You could also make the case that, hey, there's a recession risk at some point. We certainly have been in a very long market bull run, a very long period of outperformance in the US, certainly relative to other assets. There's certainly a recession risk with some of these policies potentially. We've seen talks of the Department of Government Efficiency, DOGE, D-O-G-E, right? Reducing government spending and investment. Commercial real estate has certainly been struggling with high rates recently. We've got the whole AI thing going on, reducing a lot of jobs, so impacting American consumer spending and purchasing power. So we've kind of got a lot going on here that could push interest rates either way. I think my takeaway on this is there's going to be lots of volatility either way, and interest rate projections don't mean a whole lot right now. So I think when you talk to potentially folks that are in the real estate industry, right, they're generally thinking and hoping rates are going down and being a little bit more rosy maybe in their projections, saying, oh, we'll be in the 5% mortgages next year or whatever, hoping that maybe that'll spur the housing market. I would take all projections with a grain of salt. People were saying by the end of 2024, we'd be, in the 5% range. Interest rates have stayed high. The Fed cut interest rates since the election, and we still have mortgage rates at around 7%. So a lot of people are kind of learning the hard way. If you're looking to get into a house right now, mortgage rates don't tie exactly to interest rates. It has to do with a lot of market forces, a lot of things that aren't directly tied to the Fed. A lot of people's, projections and expectations. But the mortgage market's a lot more complex. One thing that will happen if the Fed does cut rates, you will see interest on savings go down instantly. Just the same way if the Fed raises rates, you will see interest on savings go up instantly. Loans on cars, things like that will also change. Mortgage rates should also change over longer periods of time. But my only point here on interest rates, they might be higher for longer than you really expect. So if you're in the housing market or looking to refi or something like that, just kind of know that in the back of your head. You might have your current rate for longer than you think. And to pay close attention to what's going on with rates, because things can change very, very quickly when there's a lot of new policies put in place, especially after January 20th, right? When President Trump is sworn in, there could be a lot of changes happening very quickly to drive interest rates up or down very, very quickly in either direction. So just pay close attention. Okay, now our third main effect is going to be the most prominent, most prevalent, especially next year, taxes. Everyone's favorite subject. So I'll do a separate episode on this, probably pretty in-depth in early of 25 to talk about, what these policies are likely to detail and kind of how that might affect your situation. But I'll just go briefly through how I'm thinking about this as a planner with clients right now and kind of what to expect. So we've got a full Republican majority. They own the executive branch, Congress, we've got the House of Representatives and the Senate, all under Republican majority. So what does that mean? Republicans can and will get, for the most part, whatever they want done from a tax perspective. And we should expect a new tax bill likely first quarter, maybe, of 2025. They're going to push something through pretty quickly, would be my guess. So what does that mean for taxes? Well, right now, the 2017 Tax Cuts and Jobs Act, right, TCJA, were the Trump tax cuts that happened in 2017. Those were set to expire on January 1st of 2026, reverting back to the old tax structure. The likely scenario is that most, if not all, of those tax cuts will be extended, if not written permanently, quote unquote, permanently, big air quotes on that, into law, okay? We need to remember with all of this, anyone can come along in about 10 to 15 years with a Democratic majority and erase almost anything that is done right now. So again, it's not likely to change anytime soon back the other way. However, when we're talking about tax rates, tax brackets, tax laws, changes, it's written in pencil. Okay, somebody can come with a big eraser and change things drastically. But what does that mean for tax rates right now? Well, the brackets are likely not going to reset. That top bracket's going to remain 37%. All the current brackets, right, are going to remain pretty steady and just increase with inflation every year. The estate tax is likely not resetting. So the current exemption is over $13 million per person. Okay, so, a married couple, 27 something million they can give away in their lifetime and pay nothing in tax. That's the highest we've ever had by a long shot. The Trump tax cuts doubled that amount. So we're expecting that enhanced state tax exemption amount to remain high. Also, the standard deduction was also doubled under former president and future President Trump. What does that mean? Well, your itemized deductions, charitable deductions, mortgage interest, state and local tax, those aren't as valuable, and you need to have a lot of them to itemize deductions and really need to pay attention to every, $25, $50 you give to a charity. So some people still are itemizing. I've got several clients that do it, but the standard deduction is over $30,000 per person in 2024. So that's likely to remain very high. The SALT cap is one thing that may change. So the state and local taxes cap right now, you can only deduct $10,000. That's likely they're talking about repealing that. So that will allow more people to itemize when they're in some of those high tax states and are very high income. The QBI deduction, or qualified business income deduction for business owners, will also likely remain intact. This was something new with the 2017 TCJA. Some other things that, these aren't law related, but things to think about. Charitable deductions, charitable contributions. If we have an enhanced standard deduction, you're never going to hit it. And you're giving to charity, maybe we think about a donor advised fund. Maybe we think about bunching our contributions in 1 year so we can actually go over that 30-something grand standard deduction threshold and get a tax benefit for the giving that we're doing. Something to think about. Roth conversions may or may not be as important if we think tax rates aren't going to go up like they were supposed to in 2026. Certainly is something that's impacted my thinking with clients and my planning with clients. Again, we always want to caveat that pay taxes now, if we're going to let them compound over 30 years, certainly a lot of times pays off much better than letting those compound into a tax bomb. So we need to look at your personal situation and see if that, what makes the most sense for you. I can tell you most clients, I do talk them into paying more tax now. So that's Roth contributions, Roth conversions, if it makes sense up to a certain tax bracket. Again, we don't look at those tax brackets going up now in 2026. We kind of, assume those are going to be flat and constant for the foreseeable future. Again, somebody could come 10 and 15 years from now and rewrite the entire tax code and tax everybody at 70%, right? I'm being a little dramatic with that, but it is something to keep in the back of your head, especially if you zoom out and look at the macroeconomic picture of the U.S. government being in significant debt. We're running, something like a $2 trillion deficit every year. This has to change eventually. So at some point, we're not going to be solvent if we can't bring in revenue to fund our government. In general, we're in a very low tax environment right now, just the last, obviously, 7, 8 years or so, especially now with the Republican majority. Very, very low tax. Certainly is a time to be thinking about Roth conversions, Roth contributions, really loading up that Roth bucket. Again, super dependent on your tax bracket, your future tax bracket, your income. Are you going to retire early? Are you going to make money into your 70s? All these things kind of come into play when we're talking about taxes. So kind of a broad brushstroke there that probably isn't obviously specific to your situation, but just something to think about with these low taxes that we're likely to see in these next 4 to 10 years. Just to wrap up, in conclusion, one of the 3 things we think, this Trump win will affect, obviously financial markets and investments, interest rates, and taxes, okay? We could go way deeper into each of these. I will, in fact, do so in a future episode in taxes. But my lessons from this, number 1, stay invested. We saw markets, just take off after the election. I kind of talked about this over the summer heading into the election. If you were waiting around in cash because you thought it was going to be volatile around the election, you missed out on quite a bit of return there that you might never get back. Who knows? But just stay invested. If we have inflationary periods, those who are holding equities and holding, again, shares of the most valuable companies in the world that are creating value and earnings for consumers, they're going to be rewarded handsomely. So stay invested. Stay tuned to interest rates for savings, loans, mortgages, housing. So again, we don't know. The consensus right now is it's going to be higher for longer on the interest rate. So just pay attention. Things could change very, very drastically in 2025, very quickly. And then number 3, just be aware of taxes and how this affects your tax planning. It's all written in pencil. Just realize that. But we kind of can predict what changes are going to come or what things are going to more so stay the same in 2025 with a likely new Republican tax bill. So stay tuned to that. And then, as you're doing your tax planning, thinking about, all right, what does that mean for my situation and my future tax brackets? And how do I use that information to pay the least amount in tax over my lifetime? not just this year, not next year, but over my lifetime. That's all I have today. Thanks so much for listening. I hope it was helpful. Let me know if you have any questions, and we'll see you next time in a couple weeks. Thanks. Thank you for joining us today. Do you want the exact financial planning framework that I use with clients? Go visit baskinfp.com, where you can grab a free download of the ultimate military and veteran financial checklist to give you the bluff on what you need to be doing to manage your finances. We'll be back next week with some more content to help you on your journey to financial freedom. See you then.